We've got Geoffrey Dennis, independent emerging markets commentator, joining us this morning. Jeff, thanks so much for taking the time as always. I want to start by asking you about the chuckles that were in that room when Jerome Powell said, we don't know what to do with monetary policy at this juncture because so much is uncertain. What did you make of that? And if the Fed themselves don't know what to do, what hope do investors have?
Oh, by the way, Donald Trump thinks he knows what the Fed should do, which is to cut rates. But I think that it was a rather kind of simplistic statement and a bit of a surprise that somebody like a Fed chairman would say that. We don't know what to do. I think the important thing he said, which meant he doesn't know what to do, is that there is, as we've noted already, tremendous uncertainty about the economic outlook at the moment, both in terms of inflation and unemployment. So I think what he was saying, until this uncertainty begins to ease and we see whether inflation is going to move up significantly, which I suspect it will over the next few months, see what happens to the overall economy, the Fed's just saying, you know, we don't have the information that justifies a change in monetary policy. And there's nothing wrong with that. It's just the way he said it was a bit odd, frankly. But I think it's no surprise they kept rates unchanged today. And I think ultimately they will be forced to cut interest rates, although I think the economy will weaken, but inflation will rise. And I think that's going to pose a real dilemma for the Fed.
Jeff, so clearly, you know, the read from here on is, I mean, an interesting point that you made firstly is Powell thinks that he knows what Fed needs to do, but I think it's Donald Trump probably who's dictating the terms indirectly. But does this mean that there is some bit of confidence that they will be able to balance growth and inflation? Because if you talk about inflation, that is moderating to some extent. You had the last CPI read in early 2025, which was at around 2.5%. However, if it remains sticky or accelerates, what happens then? Because the impact it could have on the currency is something that needs to be eyed.
Yeah. I think it's going to be harder and harder as the year goes on, at least in 2025, for sure. Depending, of course, how much in the way of tariff policies is increased going forward. Do we get the reciprocal tariffs reintroduced after the 3-month pause? But I think it's going to be very hard generally for the Fed to maintain its dual mandate here of low inflation and decent economic growth. And as I say, I think the most likely scenario here is that growth weakens somewhat from here and inflation picks up somewhat. And that's going to present a real challenge for the policymakers. Now, of course, everybody's talking about the minus 0.3% annualized for GDP in the first quarter. But the really important number in the first quarter was real domestic final sales to domestic customers. And that came in around 3%. And that in some sense, as Jason Furman, who used to work at the Fed, says, that's like core GDP. So the economy's doing okay at the moment, but the logic would be inflation's going higher, the economy's going to slow, that's going to come out in the data going forward. And that poses a great dilemma for the Fed. I suspect they will cut rates this year, maybe once, maybe twice, but it's not going to get any easier as far as I can see.
Okay. So that's on monetary policy. And incidentally, China has also announced changes in monetary policy ahead of that the meeting that they have on trade in Switzerland. At this juncture, we're hoping that some sense prevails and things move in the right direction, but and for global growth, right? But Jeff, the question is, from your perspective, sitting outside India, in this context, would you continue to bet on India amidst that pack, the emerging market pack?
Oh, yes, definitely. And I'll tell you why. First of all, you know, we continuously get regular headlines on China doing this, doing that in terms of easing of policy. An interest rate cut was significant. The reserve requirement cut was significant. But at the end of the day, until you actually see real evidence of the consumer picking up and the property market really starting to rebalance and stabilize, I think the case for Chinese equities is not going to be that compelling. But by comparison, although obviously you've got a major geopolitical issue going on at the moment with the conflict with Pakistan, which is taking a little bit of heat out of the market, I think, at the moment. But I think the outlook for India just frankly looks better because the economic outlook looks good. You've got low inflation. They can probably cut rates again. Oil prices are weak. That's good for India. Whereas the outlook in China is just so uncertain. So for me, India is still going to be, would still, as far as I'm concerned, be a core overweight in an emerging market portfolio. Given that also the logic is that this India-Pakistan, interaction, let's call it that, military interaction, will probably not last for long. It will probably not escalate very much, and we can get back to following the fundamentals. But sure, I still like India a lot.
As you were saying that there has been talks between US and China, and in India, if you specifically look at FIIs have been biased for the last couple of months. With this increasing talks or increasing possibility of a settlement between US and China, do you think that there could be some FII outflows or FII funds moving from India to China now?
I kind of doubt it for a couple of reasons. First of all, it's really, really hard to get a trade deal. I mean, trade deals are very hard to negotiate. And we are sitting at the moment on very, very high tariffs between the two countries. So how are we going to get those down? What's the deal going to include? What's going to be, are there going to be exceptions, etc.? So I think that's the real issue here. And if we don't get tariffs reduced all the way back to where they were, let's say 10% is a baseline tariff, which I'm sure would help the Chinese market for a period of time. If this is a long drawn out process of trying to sort the tariffs out, I think FIIs are not just going to switch out of India into China. Now, if there's a big surprise and China and the US agree suddenly they're going to take tariffs back to basically base levels, yes, that money will come out of India for a period of time. But I think it's going to be really, really hard given the conflicts you've seen between China and the US on the trade front in Trump 1 and in Biden's term and now in Trump 2 to actually bring these tariffs down enough that it's going to persuade investors that China is suddenly the market you've got to be in.
Jeff, my last question coming to you is in terms of how the markets are perceiving this unchanged stance, because does this tell you that probably we're looking at a prolonged high rate policy, in turn impacting bond yields, which in turn will increase the borrowing cost, leading to an impact on the corporate capex? How do you see this entire cycle panning out?
I assume we're talking about the US here. I think that going forward, the bond yield is going to probably go up. There's a tug of war on the bond yield in the US. Clearly, the concern is higher inflation in the short term, and also the very, very high budget deficit and the debt position, which could push up bond yields. And pushing in the other direction is potential economic weakness as this trade war plays out. If you were to get a significant move higher in the bond yield, and I think it's not going to be a major move higher. We're not going above 5 or to 6% or anything for the 10-year. But if you were to see a big move, that would affect corporate financing rates, which in turn would hurt investment, which would be another problem for the US economy. But it would also hurt the housing market because mortgage rates would go further up. So I think the bond yield, the bond market is probably trading in a range because there are these alternative push and pulls on the yield, as I say, inflation and the budget deficit on the one hand and weak growth on the other. So I don't think you're going to get a big enough move higher in bond yields to really put corporate financing under pressure, at least under pressure for the reason that bond yields are going up. There may be other reasons why corporate financing may be under pressure because the economy weakens, but I'm not sure I see bond yields really doing that job at this point.
That's an interesting one coming in there, but thank you, Jeff.